We're at the end of the first quarter of 2012, and turning to the first chart, this is the story of the FTSE 100 over that period of time. Generally, we can see that at the end of the quarter, positive returns have been made. Certainly, we had a very strong start through the course of January. Still really benefiting from the impact of the LTRO programme that was launched in Europe, that caused a rally in many of the financial assets through the UK. So here I'm talking about the banks and the life assurers. Of course that trend was continuing until we've had really sort of two quite sharp pullbacks. The first was corrected very, very quickly. The second one at the moment, well, the jury is out as we enter into the next quarter as to what that means. Typically, as I say, a second pullback. This has been sort of culminating as a result of one or two concerns. China, I think, is increasingly having an impact on the market. Right throughout this quarter, some of the mining stocks have been pricing in a slowdown in China. But secondly, we have had, I think, more downgrades to economic forecasts. I think coming into 2012, there was a little bit more optimism of recovery. But we have seen, for example, Spain seeing quite sharp downgrades to economic forecasts for this year. So it's just weighing on stocks. So let's just look at a little bit more detail of Spain. I'm going to pull up a chart here of the Spanish market just to give some sort of comparison, because you can see here over that exact same period the Spanish stock market has not participated in positive gains, and indeed really just in the last few sessions of March has been on quite a spiral lower. So we're looking at quite a sharp negative return in Spain at the moment, as its own independent economic problems are impacting on its own market. But for a bit more joy, let's turn to the US. This is the S&P, and you can see that the concerns here in Europe are not having any impact on America. The concerns on China are not. S&P has continued to make fairly significant gains. And I think if we could summarise the first quarter, it is that there has been quite wide divergence regarding returns from international markets. The winners have very much been some of the stronger countries in Europe, the US, but some of the weaker players, for example, are China, some of those southern European states like Spain, and on the borderline would be the UK. The S&P, it's fair to say, has had one huge benefit, and that has been the Apple share price. This is the stock of the quarter, no question. Looking at the growth, it is the biggest company in the world. It is possibly one of the most owned stocks by hedge funds around the world, and yet has delivered quite a remarkable performance in the quarter, seeing a doubling in its share price, or virtual doubling. This is a year chart, but you can see there all of the action really took place in the last 3 to 4 months as the penny finally dropped for investors that this is not a flash in the pan type business, and that it has some longevity. So the rating has virtually doubled on the back of on very good numbers there, and that's been a huge impact, of course, on the Nasdaq market, which has hit highs not seen since the sort of really tail end of the last decade, the beginning of the last decade. So Nasdaq has been a big performer. Now, as we enter into the second quarter, one point that I made in the last sort of two bulletins has been about the VIX, the volatility index, which since that sort of European crisis period experienced here has been on a gentle decline and really coming back down to those sort of record low areas, areas where asset classes are experiencing quite low levels of volatility, just highlighting that when we get down to this level, it has been seen in the past that it can be the precursor to a bigger move. And it's just in the last couple of days that observers will have noted that, for example, the FTSE 100 index has started to post bigger losses. We've been seeing 3%, for example, taken off the FTSE 100 just in the course of the last sort of 48, 72 hours. So I'm expecting that VIX possibly in the second quarter just to pick up a little bit more volatility as we start to enter into the next quarter. It may be that the LTRO program, which has kept this market very much sort of on a reasonably upward trend through the first 4 months, is beginning to wear off a little bit now, the optimism around the LTRO program, and we're just now getting down into what I refer to as the hard economic numbers, so that is the key there. Just really finally turning again back to domestic matters. We had an OECD report published this week, which took quite a negative view on worldwide growth. OECD has typically come in more towards the lower end of expectations. They were quite critical of the UK. Where they have a difference of opinion compared to many observers is that the UK may well have been in a technical recession in the first quarter of 2012 by posting a second quarter of consistent negative quarter-on-quarter returns. We certainly know now that the fourth quarter last year for GDP was negative and slightly worse than expectations, but the OECD have gone out to say that they think that continued into the first quarter. They certainly, and it's not a view that's widely held. I think others have taken various readings and think that we've posted a positive. But what that has done, to some extent, has been weighing on equity prices. Interestingly, however, it hasn't impacted on sterling. What we see here is that sterling, for the first time in 2012, has picked its head up again against the dollar at against $1.60 at the moment. And I think if there is one trend around the world that I'm experiencing, both in Japan, America, and indeed in Europe, is this constant talk about continued accommodative policy. Certainly America were talking about it this week. And what it appears to me to be doing is that no one at this stage wants a strong currency. They all want a competitive currency to keep their economy alive. And at the moment it looks like the UK is the one that's starting to experience a squeeze on its own currency, pushing it up to 160. So just again an area to watch there. Just finally from me, a look ahead to next week. This is an interesting chart. I mentioned that the UK market is full of mining stocks housed here on our FTSE 100 index, and they have been underperformers, and it is partially the reason why the UK has been a little bit of a laggard this year compared to some of those other markets around the world. And it is because miners have been, I think for the last 12 weeks or so, pricing in a slowdown in China. Rio Tinto here touched £40, back down as low as £33 here during March. There is a bit of a bounce going on, and what I would turn to is that on Sunday night our time, Monday morning, we will have publication of the Chinese PMI index. There has been a rumour around this week that number may surprise to the upside. So if the market's been weighed down by negative sentiment around China, there may be room for optimism around China next week, and it may be that some of these mining stocks will bounce on the back of that.